Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. We are diving deep today, really trying to connect the dots on some of the biggest stories out there.
Yeah, it feels like everything's happening at once.
It really does. So we're synthesizing the reporting from the big ones, CNBC, the Financial Times, Reuters, and Bloomberg.
And the mission today seems pretty clear.
I think so. We're connecting this blistering, high-stakes AI capital war with these totally diverging signals we're getting on global interest rates.
And all of that is set against this backdrop of huge geopolitical shifts in supply chains.
Exactly. We're looking for the threads that tie all three of these areas together to give you a shortcut to understanding what 2026 is actually going to look like.
It's a moment of, I'd say, maximum tension. You have all this capital just flooding into AI firms at valuations that are, almost unbelievable. And at the same time, you have central banks in, developed economies acting on completely different playbooks. One's worried about a recession, the other's still fighting inflation.
And we really need to dig into that divergence.
Yeah.
Because that's what dictates the cost of capital, the risk appetite for all these huge tech investments we're about to talk about.
It all comes back to the money.
Okay, let's unpack this with the story that it dominates every financial conversation right now, the AI funding frontier.
Mm-hmm.
The biggest news coming out of the Financial Times is that Anthropic, the key rival to OpenAI, maker of the Claude chatbot, is reportedly preparing for one of the largest IPOs ever.
The scale of this is what just stops you in your tracks. They've engaged Wilson Sonsini,
The dream team.
the IPO dream team, Google, LinkedIn, Lyft. This shows they are deadly serious about getting ready for the public markets, and maybe as early as next year.
But what I found really intriguing, and the FT reports this, is their dual-track strategy. This isn't just about an IPO.
No, it's much smarter than that.
At the same time, they're chasing private funding that could push their valuation over $300 billion.
An incredible number, and that includes a combined $15 billion from guys like Microsoft and NVIDIA.
So what does that dual track actually signal to the market?
It's optionality and, frankly, confidence. The IPO track gets all the boring legal and financial stuff done. It gets them ready to pull the trigger if the market is perfect.
Right.
But the private funding track is their hedge. It makes sure they get the massive capital they need right now to keep building models and buying GPUs, regardless of what the public markets are doing.
So this is the ultimate test, then, for investor appetite. Are they willing to buy into these high-burn AI firms when everyone is whispering about an AI bubble?
Exactly. And the company's official line to the FT is that they are operating as if they're publicly traded. That means they're getting their compliance and reporting in order, which is a huge step.
Okay, so that brings us straight to their main rival, OpenAI.
Yeah.
Jim Cramer's commentary, which CNBC picked up, paints a pretty grim picture.
Mm-hmm.
He argues OpenAI's real code red isn't just Google's Gemini 3 catching up. It's a full-blown existential capital war.
And that's where you see the gap just become this chasm. Alphabet, Amazon, Meta, Microsoft, they can basically self-finance their AI ambitions, or they can borrow tens of billions for next to nothing.
Because their balance sheets are so strong.
Exactly. OpenAI, on the other hand, is already heavily indebted. They just don't have that same access to cheap capital. And in this race, the model that scales fastest wins, and scaling costs a fortune.
And Cramer's suggested fixes, settle that big lawsuit with the New York Times, stop the bleeding there, or get Microsoft to double down. It just shows how urgent this is for them.
You can't win a capital war when your rivals have essentially an unlimited credit line and you're running on fumes.
And this war extends beyond just the models themselves, right? It goes
Yeah.
into the actual physical infrastructure.
It has to, which is where you see these huge M&A deals, like Marvell Technologies' aggressive move, reported by Reuters, to buy Celestial AI for $3.25 billion.
And the market loved it. Their stock jumped 9% pre-market on the news.
Of course, the market gets it.
So let's pause and just clarify the tech here, because this is where it gets really, really interesting. Marvell is buying photonic tech.
Right.
This isn't just a small step. It's the next generation of how data centers are connected. So instead of old electrical signals, which are like, congested roads,
A good analogy.
photonic tech uses light. It's like upgrading the whole network to a fiber optic superhighway. Why is that so critical right now?
Because the sheer amount of data needed to train these advanced AI models is creating a bottleneck in the current electrical systems. Photonic tech uses less power and it's exponentially faster.
So by buying Celestial AI, Marvell is basically jumping the line.
They're jumping the line and directly challenging the big guys, NVIDIA and Broadcom, in providing the hardware for the future of AI.
And to add some validation to that, Reuters also highlighted the Amazon endorsement.
Yeah, this was a big piece of the deal.
Marvell issued a warrant letting Amazon buy their shares, but it's tied to Amazon's purchases of these new photonic products through 2030.
That is a massive vote of confidence from a hyperscaler like Amazon. It immediately makes Marvell a, quote, stronger contender in this whole infrastructure fight.
Absolutely. And you see the money flowing in already. Just look at the earnings snapshots. CrowdStrike, for instance, forecasts Q4 revenue way above estimates.
And the driver?
The driver is robust demand for AI-powered security systems. AI isn't some future research project. It's an immediate, necessary tool for enterprise. And that market is hot.
Yeah, that's for sure.
Okay, so let's leave the $300 billion valuations for a second and pivot to the central banks, where the signals could not be more mixed.
Talk about divergence.
In the U.S., the market is pricing in just enormous odds, something like 89%, according to the CME FedWatch tool that CNBC cited.
89% for what?
A quarter-point rate cut at the Fed's next meeting on December 10th.
Wow, that's incredibly optimistic. But it's all built on anticipation, not actual data yet.
Exactly. Because of delays in government data releases, traders are laser-focused on this week's reports before the Fed goes into its blackout period.
So they're watching ADP private payrolls, the ISM services PMI.
Right. Those are the last real-time looks at the labor market and, non-manufacturing inflation. The Fed is data-dependent, and the market is just desperate for any data it can get.
And then there's the whole political layer, which Bloomberg detailed really well.
Yeah, the shadow Fed factor.
Right. Traders are betting that monetary easing will speed up after Powell's term ends in May, especially with all the speculation around Kevin Hassett as the next potential Fed chair.
So what does that do to the market now?
It creates this shadow Fed chair phenomenon. Traders start pricing in a more growth-focused policy now, even while Powell is still in charge. The potential for confusion is it's huge.
But the core risk is still inflation, right? If the market forces a rate cut or the Fed cuts while inflation is still sticky, what happens?
That is the big danger. It's what Jack McIntyre at Brandywine Global flagged in Bloomberg. You cut rates too early, and you could trigger a bear steepening.
Okay, so break that down for everyone listening. What is a bear steepening?
So it's when the Fed cuts short-term rates, which sounds good. But the market gets worried about future inflation, so long-term bond yields, the 10-year, the 30-year, they actually rise sharply.
And why does that matter to, you at home?
Because rising long-term yields mean your mortgage rates, corporate borrowing costs, they actually go up.
So financial conditions get tighter, even though the Fed is trying to ease.
Exactly. It completely destabilizes the bond market and just cancels out the whole point of the short-term rate cut.
Okay, now let's contrast this whole dovish expectation in the U.S. with what's happening in Australia, where they are feeling some genuine inflationary heat.
A completely different story.
CNBC reported Australia's Q3 GDP growth was 2.1% year-on-year. That's a fantastic pace, the fastest in about 2 years.
And the strength is all domestic. It was fueled by incredibly strong domestic demand, and private investment saw its fastest pace in years.
In what areas?
Think commercial construction, specialized machinery, and crucially, data centers. The Australian consumer and corporations are spending.
But that's the RBA's problem, isn't it?
Yeah.
This strong growth is hitting a wall of persistent inflation.
It is. Inflation accelerated to 3.8% in October, still way above the RBA's 2 to 3% target band. Analysts quoted in CNBC are very clear. The economy is, quote, still too hot for the RBA's liking.
So what does that mean for their policy?
It means rate cuts are absolutely off the table for them. And you can't even rule out another hike if the data keeps coming in this hot.
It's just an incredible divergence. The U.S. is betting on easing while Australia is still fighting an overheating economy.
The macro pressure is immense.
And shifting to Asia, the CNBC China Connection newsletter outlined what they're calling a triple drag on the world's second-largest economy for 2026.
First, you have the property woes, which are just not going away. You have giants like Vanke trying to delay bond repayments. That just kills what little buyer confidence is left.
And the numbers are staggering.
They are. Sales by the top 100 developers plunged 36% year-on-year in November alone. This is a structural crisis, not a downturn.
And that links right into the second problem, which is weak consumption.
Right. The policymakers are all focused on the supply side, integrating AI into manufacturing. But critics point out the huge blind spot. There's no real policy support for job creation or income gains.
Which is what you need to actually boost demand.
It's the core issue. If people don't have stable jobs, they won't buy apartments, they won't spend. And you see the strain in the data. The household bad loan ratio is now higher than the corporate bad loan ratio.
Wow. That's a huge red flag.
A huge sign of consumer stress, which leads right into the third flashpoint.
Yeah.
Deflation.
Right. Jean Ma, the Institute of International Finance, was quoted saying China's major problem is just a fundamental lack of demand.
And you can see it. Headline inflation is near zero. If you strip out the weird surge in gold prices, core CPI was only 0.9% in October. There's just no pricing power.
So that structural weakness in China has to have an immediate consequence, which brings us to global supply chains.
Exactly. We're seeing Vietnam rapidly, and I mean rapidly, solidifying its role as a key manufacturing alternative. This is a quiet shift that's going to reshape global commerce.
And this isn't just opportunistic, it's strategic. Reuters highlighted the scale of the commitment here. Foxconn is seeking permits to massively expand output in Vietnam.
And we're talking about huge capacity increases, up to 4.8 million Microsoft Xbox devices a year, boosting mobile phone capacity to 140 million units.
And it's not just Foxconn, right?
No, China's own Luxshare ICT is doing the same thing, planning to make up to 4.5 million game consoles a year in Vietnam. Its manufacturers actively de-risking their supply chains, getting out of that China OS friction zone.
And it was interesting that Fushan's facilities could also produce equipment for up to 100,000 drones a year. That really shows the strategic nature of this.
It does. And on the diplomatic and energy front, you see another critical strategic shift with India. CNBC detailed Putin's upcoming visit.
For their 23rd annual summit.
Right. And this just signals India's determination to maintain its own foreign policy, even with the U.S. putting punitive tariffs on them for buying Russian oil.
They're clearly prioritizing the relationship. They're aiming to expand their trade to $100 billion by 2030.
A huge number. Though India is trying to balance that trade deficit since they import way more than they export to Russia, but experts are asking a really critical question.
Can Russia actually deliver?
Exactly. Can they honor major defense deals, like for Su-57 jets or S-500 missile systems, when they have their own domestic chip shortages and geopolitical issues?
It's a relationship built on necessity, but constrained by logistics.
Right. Now, switching gears completely, Bloomberg reported on this tentative recovery in the crypto space. Bitcoin rose to a two-week high, around $94,000.
Which is a nice recovery from that big fall from 126,000 in October.
And that bounce seems to be fueled by some good technical news. A bit of risk appetite coming back to the stock market, rumors of an SEC innovation exemption, Vanguard finally allowing crypto ETFs.
But the tone seems really cautious.
Very cautious. Analysts in Bloomberg are calling it a relief rally. They say sentiment is still fragile, and they pointed to the, quote, feeble $59 million inflow into Bitcoin ETFs on Tuesday.
So institutional money is still on the sidelines.
It's hesitant to jump back in with both feet.
And finally, let's look at a policy change in the UK that has huge implications for startup funding. CNBC detailed this.
The autumn budget?
Yeah, they included a reduction in the upfront tax relief for the Venture Capital Trust, or VCT, scheme, cutting it from 30% down to 20%.
Okay, so for listeners, VCTs and the related EIS scheme are basically massive tax incentives to get private investors to put money into high-risk, early-stage UK startups.
They're the lifeblood of the UK tech scene.
Absolutely, and that seemingly small 10-point cut caused outrage. Industry leaders called it utterly nonsensical and a stupid change.
The fear is that it's going to undermine investor confidence immediately and just slow the flow of capital to those startups.
Even though the government tried to balance it by raising some investment limits?
Right. But the Treasury is banking on saving about £125 million by 2027. The industry is basically saying they're trading short-term fiscal savings for long-term damage to the whole UK tech sector.
The cost of capital for those startups just went up. Simple as that.
Okay, let's try to synthesize all of this for you. We've covered three massive global currents. First, the incredible speed and scale of this AI capital race. $300 billion valuations, billions more for infrastructure. That's the Anthropic and Marvell story.
Second, this tight, divergent global macro environment. The U.S. is betting on cuts but risks a destabilizing bear steepening. Meanwhile, Australia's economy is so hot, the RBA has to keep hikes on the table.
And third, the strategic realignment of manufacturing to places like Vietnam, which is a direct consequence of the structural problems,
Yeah.
the property crash, the lack of demand that we're seeing play out in China.
The thread that connects all of it is the cost and availability of capital in a really complex geopolitical world. Every single win, whether it's beating OpenAI, building a data center, or moving a supply chain, it just demands billions and billions of dollars.
So here is our final provocative thought for you to explore. Given that the scale of capital required to win this AI race is just so impossibly large, you see it with Anthropic's funding, OpenAI's debt, Marvell's acquisition, are investors fundamentally underestimating the risk that the AI capital war itself, this relentless need for massive constant cash injections, could be the ultimate trigger for the tech bubble correction everyone fears?
In other words, the revolution might run out of money before it runs out of ideas.
That's a powerful note to end on. Thank you for joining us for this deep dive into the source material. We'll see you all tomorrow morning with new headlines from major financial magazines.